Okay, we'll go ahead and get started. Welcome everybody to today's webinar on balance sheet management as part of our Profit Leader Masterclass series. I'm Christy Speed, Marketing Director at FMS. Before we dive in, I have a few quick notes. This session is being recorded and will be available on our YouTube channel for viewing later. Please feel free to use the Q&A section if you have any questions during the presentation, and I'll put a few links in there that you might need later on in the presentation as well. Now I'd like to introduce our speaker, John Cline. John has an extensive background in the grocery industry in both operations and CFO roles. His many professional roles have included accounting, finance, merchandising, operations, sales, corporate management in wholesale, retail, and CPG environments, and now as FMS's Client Relationship Officer. Welcome, John.
Christy, thank you for that fine introduction. I couldn't have written it any better myself. So anyway, a bit as we have a lot of folks still joining. So a bit about FMS. We are an outsourced accounting company. We are accounting as a software company. We're a technology company in terms of our GOT offering, which helps with shrink control, grind logs, ordering, etc. We now have a multiple offices that engage in tax preparation and, more importantly, tax planning. We also offer consultative services as well as CFO fractional share type work from an FP&A perspective, a profit enhancement perspective, etc. So if we can help in any of those ways, certainly reach out to Christy or to me, and we'll get you into the queue to do so. So, not the most glamorous thing to present, balance sheets, but that's what we're going to talk about today. I think I don't know how many accountants. It looks like a fair amount of our staff is on here. From a standpoint of balance sheet, the notion, from my perspective, is as a financial statement is what falls out between two balance sheets. Balance sheets, of course, are a point in time snapshot of your assets, your liabilities, and your shareholder equity. The old mathematical formula of assets equals liabilities plus shareholder equity. I'm sure many of you, do a personal financial statement from time to time. A business balance sheet isn't terribly different types of accounts maybe, but at the end of the day, it tells you, fundamentally what you own and what you owe and what your net worth is as a result. A balance sheet's very similar. So when you look at a balance sheet, and I don't know who all is on the phone today, so if I'm insulting your business acumen, apologies, but we're trying to build from the same spot to have a common base. When you look at a balance sheet, assets are typically, if it's on a page where you've got assets on one side and liabilities on another, typically assets are on the left, and it's ordered in terms of liquidity. So your current assets typically in retail will range from cash, which of course is your most liquid, to short-term investments, maybe a CD or a money market, down to receivables and into inventory, to get to your total current assets. Your non-current assets are assets that have a longer life, i.e. more than an operating cycle. If you think in terms of a typical retail balance sheet, you're probably cycled down to fixed assets. If you're an AWG client, you may have some long-term AR or notes receivable from owner, et cetera, maybe down to intangibles. Again, ordered from most liquid to least liquid on the asset side. Liability side, so now we're thinking about the right side of a typical balance sheet presentation. Also ordered in terms of I guess, liquidity or liquidity about to go out of the door. Current assets, or excuse me, liabilities are almost always top of the page. Accounts payable wholesaler, AP trade, various accruals, perhaps your sales tax accrual, your payroll accrual, etc. Get down to total current liabilities. Longer-term liabilities may be a notes payable, it may be to a bank or a lender, or notes payable to owner. Nowadays, I should have said this earlier, back in assets, your longer term asset might be a right of use, a right of lease use asset. And on here, you may have that liability for your longer term. That's that ASC 42 that has to be on the balance sheet in terms of lease liability as well. And of course, the owner's equity, right? This is what's been contributed by owners of your company. If you're a C Corp or an LLC or an S Corp, whatever partnership, whatever it might be, you typically have a stock, some par value of stock, maybe issued 10,000 shares at $1 par, and you'll have additional paid-in capital. You might have some treasury stock. Then you'll have earnings life to date, which are your retained earnings. And of course, you're gonna net out any owner distributions or dividends to get there. So in our world, in the FMS world, we prepare thousands of financial statements per period, tens of thousands per year. Typically we like to give you a P&L, a cash flow statement, a balance sheet. The one thing we preach incessantly on this side of the screen, if your balance sheet is wrong, your P&L is wrong. As I said earlier, the old adage that a balance sheet is simply a squeeze between a beginning and ending balance sheet is I think absolutely accurate. And if your balance sheet wrong, then your P&L is wrong. So for example, if your inventory and your current assets are wrong, then your margins are going to be wrong, right? Because you have a misstated asset on your books. Here is a blank version of the balance sheet I was talking about earlier. Assets on the left, ordered in terms of liquidity, liabilities on the right, and every balance sheet looks different, but this and equity at the bottom right. So that's what a typical balance sheet looks like. You know, who uses your balance sheet, right? It should be everybody in your organization, frankly, but bankers do, lenders do, owners do, hopefully your operating folks do in terms of some of the things they control. But you know, there's some key balance sheet ratios. You can look at if you look at enough balance sheets, which you know I do, our accountants do, our managers do. You can quickly look at a balance sheet and know, frankly, the financial viability of an organization, right? Some of that is liquidity, some of that is maybe more importantly, if you go back to pre-2020, pre-COVID, illiquidity. You can look and see how if a customer is or a business is reinvesting in business, or if not, you can see how much money they're taking out of the company or reinvesting. You know, current ratio. When I'm one of my prior jobs at SuperValue, I was in charge of credit. Current ratio and the quick ratio were extremely important things that I would look at. They measure liquidity, they measure short-term liquidity, and it's, you know, the current ratio is your current assets divided by your current liabilities. And if you think about it, right, you've got cash on hand, you've got cash in bank, you've got inventory, you've got AR you need to collect, you've got to turn that inventory, you've got to sell it first. But your ability to meet your current liabilities, again, your payables, your accruals, your employees, your utilities, your rent, all of those things are measured by the current asset divided by current liability. Less than 1 means you're illiquid. 1 means you're just barely liquid. I like, you know, and I'll show some stats on this in a minute. I like to see above 2. It's not always easy to turn your inventory into cash in a short enough time. The quick ratio is cash plus AR, so we're excluding inventory from that current ratio divided by current liabilities, and that gives you an idea of what you can do in the next handful of days in terms of paying your bills. Inventory turnover, also called inventory turns. You take your annualized cost of goods divided by average inventory, and that gives you an idea of how well you're managing your inventory. We'll show some stats from the FMS NGA survey or annual report here in a few slides. Days sales outstanding. A lot of my customers don't have a lot of AR, but some do, right? If you have, you know, in-house charge, if you have pharmacy, you certainly have receivables, and that's, you know, it's something you want to manage to the degree possible. But your accounts receivable divided by average daily sales. Return on assets, it measures your efficiency of your asset investments, revenue divided by total assets. How many times are you turning those assets over? So one of your assets is inventory. How many times are you turning that over? There's also a lot of capital assets in grocery stores, refrigeration and buildings and cash register systems, etc. That's a good way to measure your efficiency. Net working capital, your ratio, your current assets minus current liabilities divided by total assets. It gives you an idea of where your dollars are invested. You can compare yourself to your peers. If you're cash strapped, you're liable to have a very low ratio of current assets to total assets, or working capital. If you're over inventoried, you may have a high ratio there. Debt to assets is simply a leverage. Your assets divided by liabilities. Debt to equity, the same. Liabilities divided by equity. I've had a lot of jobs in my life. I guess it's because I can't keep one. But one of them was I was a lending officer at a family-owned bank. What do lenders look at? There's three primary areas that a lender looks at is your ability of the borrower to repay, right? Everybody thinks, well, it's about collateral. That's really third on the list. Nobody wants to repossess collateral. So the ability of the borrower to repay. And a lot of those ratios that we just talked about, and that you can also, and I got a misspelling here, that you see on the right are key to that. So debt to cash flow, debt service coverage, which is oftentimes a loan covenant. Net income, or EBITDA, divided by debt service, debt to assets, debt to equity. A bank doesn't want to have a high debt to equity ratio. They don't want to take all the risk. Debt to EBITDA, how many times how many more times or less times is your debt to EBITDA? That quick ratio we just talked about in terms of do you have enough current assets, cash, inventory, et cetera, to meet your current liabilities, which will oftentimes include your current portion of any mortgage you might have. Interest coverage ratio, which is your EBIT divided by interest expense. Again, your ability to repay. But banks they want you to be able to repay based on your balance sheet strength, your ability to generate cash in the future through operations. They want to have history of a borrower repaying loans. And lastly, it's collateral coverage. I mean, collateral is the last defense really of when you get a loan. You got to have accurate and timely financial statements are crucial to the process of getting lending. Again, harping on what I've been talking about for the last couple of slides. Your balance sheet has to be accurate for your financial statements to be. And of course, well thought out pro formas and cash projections are crucial anytime you're dealing with lenders. I put this slide together. I made a presentation along with Stan and Gary out at ROFTA, and we don't have so when you see the 22 report, that's 21 numbers. So when the report came out in 23, the 24 report, Christy, will be out shortly. I hope that'll be the 23 numbers. But you can, this is kind of it kind of combines some P&L results as well as balance sheet info. You can see 2019. Interesting to me that 2019 versus 2021 inventory turns were about the same. Inventory turns, of course, went way up during the actual COVID months of 20 and 21. Remember again, an inventory turn is the number of times you're turning inventory per year. So if you have, just rough math, if you have 20 inventory turns, divide that by 360, you're holding on to what is that, 18 days of inventory, et cetera. So when you start thinking about how much money do I have invested in inventory, and you think about how many wholesaler trucks you get a week, or how many DSD deliveries you get a week, what is the right number, right? It varies. Some of you will get less deliveries than others. Some of you are further away from warehouses than others. But if you're getting 3 to 4 deliveries a week, you probably don't need 18 or 20 days of inventory on hand. Getting down below, I think we're going to see in gross margin, I think we're going to see an absolute lowering of this when we see the results of the study. And again, this should be out, I'm hoping, in the next couple of weeks. We're definitely seeing a squeeze in margin this year, I think primarily for 2 reasons. One is sales are flat to down. It certainly did not help sales anyway. When the SNAP was normalized, when the COVID emergency was ended. But our customers, your customers, just like us as individuals. We have been absolutely stressed by inflation across the board, not only in food, but in car insurance is up 20% year over year. Literally, interest rates are at 20-year highs. There's a lot of stress on discretionary income. So we're seeing a lowering of sales and a concordant impact on gross margin as we see more ad shopping. We see more deals being offered, BOGOs and deeper ads, hotter ads than they have been. Down below, you can see asset turnover. In 2019, it was really high, and then it kind of fell as I think what happened in 20 and 21. My suspicion is with PPP and just the overwhelming amount of money that came into retail coffers from sales and high margins and government programs. We saw people invest. You can see that continued, frankly, through 2021 and 22 on this slide. Conversely, debt to equity is really good, right? I mean, it's a ratio of at 0.2 at the end of 2021, which would have been 20 again about the time a lot of PPP came out. Look at the absolute benefit, the recapitalization of balance sheets. When you look at that current ratio, again, will be interesting to see. I suspect that may slide a little bit, but COVID, while it was certainly tough from a societal standpoint, was really good for our balance sheets and our performance. So when you think about your balance sheet and your ability to quickly generate cash, to manage cash, the one thing we see every year in the NGA FMS survey is that our best performers are folks who manage inventory well, because it typically it's one of the key tools in shrink management. When you think about the more inventory you have, the more times you have to touch it, the more times that some of it will age, the more investment in it, the more times you have to go back and restock a shelf from back stock, et cetera. So you can see here the numbers over the last few years in terms of turns. Certainly we hit really high in 21 and 20 respectively, and 22 wasn't bad either in terms of that. So higher margins. What do I think inventory turns management yields? Higher margins through lower shrink and product damage. And again, every year, and I put that in all caps reason. I mean, for the last 20 years, we've done this report. Shrink is the most common trait of top quartile EBITDA performers. It's one of the few things you can control, and it just contributes dollar for dollar to your bottom line. Higher consumer satisfaction. I mean, nothing irritates me more than to buy some yogurt or some other product, maybe a mayonnaise or a salad dressing off the shelf, and you get it home, you realize you got 2 weeks or 2 days to use it. So higher consumer satisfaction by buying fresher products off your shelf, less labor expense because you're not constantly restocking and going back and forth and wondering what's there and what's not. It frees up dollars to invest in your business. Maybe you pay down some debt with it, right? I mean, as you can see below, the prime rate has doubled since the Fed stepped in to manage inflation. Now get on my soapbox a little bit. Balance sheet. Why is it important? Why does all this matter? Your lenders, your investors, your owners, they want to know what the risk is. They want the risk and investment managed well, and that's how they review your balance sheet, right? That's how a lender or maybe a potential buyer of your business looks at how well it's been managed. Do you have the right amount of recapitalization in current assets? Are you putting money back into your business in terms of refrigeration and other fixed assets, equipment? The worst time I've worked in turnaround situations many times in my career. The worst time to need a loan is when you need money for operational needs, i.e., I can't make payroll this week, I can't pay my vendors. So balance sheet management allows you to see that crunch coming. If you get out in front of it and go to a lender and say, look, we're very profitable. I simply have a cash crunch. I can see it coming in 60 days. Maybe I've got a loan coming due, or I've got to pay taxes. They're much more likely to give you the loan you need and at advantageous terms if you're ahead of that, as opposed to coming to them in a crisis mode. You certainly can squeeze dollars out of the balance sheet through inventory management, as we spoke about earlier, and AR collections, right? I mean, if your terms are 7 days on AR or in pharmacy, whatever it may be, work those subledgers, work it and try to get money out of it. Squeeze a day or two out of your AP. You're probably, if you have historically paid on time to your vendors, squeezing a day or two extra out of cash is very viable. Now, if you've been late, then maybe you can't. But if many of my customers pay, in my opinion, way too early. I get it. They just want to get it done. But if you get vendor terms, take advantage of those and maybe squeeze a day or two occasionally. Some suggestions. Balance sheet review should be as much a part of your financial review as the cash flow statement and your P&L. It may not take as long as your P&L because P&L certainly has more data elements, but it should be part of your thought process. It should be, as I say further down, it should be part of your management incentive plans. I get it. You do buy inventory from time to time. One of the beauties of our GOT system, it's got for AWG supply customers, it's got a same day to save or last day to save feature that says, hey, this item the price is going up next week, or it's going off deal, or maybe both things. I get it. You've got to invest in inventory, but do you really need 92 Jellos on the shelf? Obviously, you guys have to make that decision. Benchmark, as we had, it's in our survey every year. Benchmark yourself against the industry. You can Google or search for public companies' balance sheet ratios. Compare yourself to others. Benchmark. If you've got, again, I see a lot of balance sheets. I do a lot of balance sheet reviews for what our accountants do. I do it for the stuff that I do. If you're sitting on cash, right? I'm treasurer for our homeowners association, and at certain times of the year we have a lot of cash as we wait to pay maybe insurance or whatever. Put it, you can easily get a money market today, an overnight money market of some sort at 4%. If do some cash flow planning, put it in a CD. I mean, 4 or 5% is better than having it set in your checking account earning nothing. Manage that on a day-to-day basis. Big companies do, or just pay your debt down, right? Maybe you get a line of credit, you borrow as needed, but you keep your long-term debt paid down. At 8.5%, 9%, doesn't take much debt pay down to equate to some pretty good dollars. Again, balance sheet, why does this all matter? They taught us in school that as a controller, and for all of my accountants or the company's accountants on the call today, we are controllers for our companies, right? It may be fractional share, but we are controllers, and it's our duty to help with asset preservation. I could take the next hour up and regale you with stories, not pleasant ones, of items that our employees over time have found in terms of employee theft. I'll tell you the one thing, it's always the constant thing you hear. I never expected him or her to be the one that would steal from me. And so you've let your guard down. You didn't exercise good segregation of duties or other types of internal controls. So it's, I certainly don't want to paint society with a broad brush, but there is a certain percentage of our employee base and of the population that want to steal. And while they will still baby formula or meat, what they really want to steal is cash or something they can convert easily to cash. And so I obviously found this somewhere on the web, but it talks about, the fact that employee theft right now is at an all-time high. Who knows if these stats are real, but when you think about somebody quoting 75% of employees have stolen at least once from their employer, oftentimes business bankruptcies are due to employee theft or in Red Lobsters in case they sold too much shrimp. But 90% of all theft losses come from employees. And I'm telling you, we see this every day. A clerk steals, a cashier steals through sweethearting, whatever it might be. There are things you can do, right, where I'm leading to with all this. There are things that you can do to catch that, to dissuade it, to prevent it, and to catch it, right? So, as I said earlier, people will steal anything, right? You leave it laying around, they'll steal it. But what they really want to steal is cash, right? So if you are not reconciling your cash equivalents, by that I mean your actual cash, your cash in bank, your cash on hand, somebody's got a little paper sack with 14 rubber bands around it and says this is stale checks. Every now and then, check that out, right? Make sure it's not just some torn up piece of paper. We've seen that, right? Everything I'm quoting, we've seen. But reconcile your cash, your money orders, your Western Union, the bill pay, lottery, coins to cash. Umpteen times I've gotten beginning. These are honest to God true stories. Beginning balance sheets from a former accountant, accounting service, and we get it. And we'll see an ATM machine balance in a single store. Again, $80,000 plus, not a made up number. The daggone things hold $4,000, right? Look at it with a skeptical eye, reconcile it every month. If you're not, if you don't, your employees will know you won't. And you'll see it all the time. It's like going walleye fishing. You put that little 3 tug on your line, you'll see a $50 money order difference. You'll see a $50 Western Union difference. You'll see, whatever it might be. They're testing to see if you're going to catch them. Reconcile it weekly or period every time. Inventory cycles, and I know I get some disagreement with this. I'm a big believer in monthly perishables and quarterly center stores. I know an emerging trend is trimester. But if you've got a theft issue, if you've got a margin issue, if you're not, for whatever reason it might be, the sooner you surface that issue, that you realize it, the quicker you can effectuate a solution for it. Ensure your subledgers, accountants, AP, AR, etc., fixed assets. Make sure it ties to the ledger. If it doesn't, could this be a mistake? It could be a theft problem. Right? Really, I mean, you just never know. If especially the AR sub or the AP, right? Things going out. Tie your long-term debt to your bank schedules. Use the metrics we talked about above to monitor your financial health. Make it part of your company culture. Internal controls, segregation of duties. I know many of you are small business owners. You got to really be careful with giving an employee the right to set up a vendor, enter an invoice to pay, cut the check, reconcile the account. To the degree that you can segregate those duties and put in place controls to verify the processes that you have to deter theft, the better that is. So if you may have the world's best backdoor receiving policies. Are they being followed, right? Are they being subverted? So every now and then, go inspect that. Say, hey, vendor, I know it's going to take 10 minutes longer. Let me buy you a sandwich or a soda, but we're gonna check this in again, or something to that ilk. Substitute backdoor receivers from time to time. Don't let the same person count cash every time. In a bank, they make you take vacation. As opposed to because they want people to come behind you and find that. So segregation of duties, rotation of duties, internal controls are all very important. So that's all I have relative to balance sheet. Christy, have any questions popped up?
Not yet. I think you could go ahead to the Outlook. Those
Awesome.
Next files.
Thank you.
Yeah.
So again, this is a little bit outside the balance sheet side of things. What are we seeing in 2024? Again, I do some financials still, review a lot more. We're certainly seeing a sales normalization to pre-pandemic inflation adjusted sales. Inflation, though, still not completely under control, although I did see just today that it is improved, but it's still not completely under control. Your customers' discretionary income continues to be squeezed, which probably is going to decrease sales, and certainly I think is going to soften margins as customers continue to trade off and buy your ad more heavily and trade down some. Competition is growing. Aldi and dollar stores are they're proliferating. Inflation across the board below the line, i.e. wages. Even my wife and I split time between Florida and Oklahoma. Even in Oklahoma, a very conservative state, they're going to put up, looks like on the state ballot next year, the ability to raise minimum wage. Florida, Missouri, Arkansas have already done the same. So that you're going to continue to see that. We know utilities are up. We know insurance is up. So we're going to continue to see that. As a result, you're going to see profit and EBITDA squeezed. I think for those who have done a good job of keeping a healthy balance sheet, I think time is ripe I think we're going to see retailer consolidation. And for those on the good side of the balance sheet, I think we're going to see you have the opportunity to buy stores. Keys to success, it's the little things, right? Shrink control, continue to maintain pricing. The folks I saw that didn't do as well as others during the pandemic and during the inflationary time, they weren't doing price maintenance. Seems like a simple thing, but they got behind. You've got to control your variable expenses. Think about labor. Maybe if we continue to see inflation, measure it at the units as opposed to sales level, right? It's because you don't want to say, well, I'm still just 10.2%. Well, maybe you should have been 9.9 because inflation benefited you on the top line. Remember, percents pay the bill, or excuse me, dollars pay the bills, not percent. So, chasing sales against overall margin degradation, you've got to measure that, right? So I guess what I'm saying here is don't just heat up your ads so much that you drive top line at the expense of margin. You pay the bills with margin dollars, not with sales dollars. Cost of cash and debt management, inventory turns and asset, maximize your inventory turns, maximize your asset turnover. Take advantage of opportunities if you've got the ability, mergers and acquisition. I think those are going to be. I've seen more stuff go up for sale in the last year and a half than I've seen in the last 15. So there are opportunities out there if you've kept your balance sheet in a good shape. Lastly, the next one of these will be in August. You can find this at fmssolutions.com. We strive very hard to provide meaningful feedback to the industry. Christy, do we know when we're going to see the NGA FMS study come out?
We should be soon. Should be soon. I don't want to give you a specific date, but it's coming.
All right. So, keep an eye out for that. A great benchmarking tool, a great barometer of the industry to help you plan. So if you have any questions that you didn't surface today, my email is on this last slide. And thank you to our customers for being our customers. Thank you to our associates for doing a great job for our customers. And again, reach out to me if you have questions. Christy, thank you for organizing today.
Thank you so much, John. This was really good. Thanks, everyone.
Take care.
See you next time.